Something's changed in the stage. We've got some very forward-looking gentlemen over there.
Hi, I'm Eric Goby. I'm based in Silicon Valley. I work with Speed Invest, founder and general partner of the new fund here in Austria. And so we'll be moderating the panel today. I'll let these guys go speak. We'll be talking about lessons learned. So we've got a bunch of successful entrepreneurs and financiers, and hopefully we'll get some interesting stories that you don't often hear, about mistakes, things that could have been differently, and get a little bit of insight for the startups that are attending. So I'll let the guys just say a couple sentences and introduce themselves.
Hi, my name is Christian Handel, and about 10 years ago, I had the crazy idea to launch an airline. It was actually on the 6th of September 2001, so 5 days before 9/11. And then we took it public on the Vienna Stock Exchange in 2005. I sold my shares in 2007, and 2 years later the airline went bankrupt. So I have a few things to share with you about the good and the bad experiences from the Sky Europe story.
Hi, I'm Pavel, and together with my partners I run an investment company called Point and Capital. We run it out of Berlin, Germany, but we invest all around Europe. And we focus on early stage investments and targeted, in the internet space. So that's everything we do. And we've been doing it for a couple of years now, so we have a lot of expertise and we've seen many things, and we're happy to share our insights with our portfolio companies.
Hello there, my name is Mark Cardina. I'm an entrepreneur based in Vienna here. I had founded the company back in 2004, I guess. Raised 2 rounds of funding and then sold the company last year to an organization called Digital River, which is listed on the NASDAQ. Stayed on board for about half a year. And since October last year, I'm the CEO of Wikicube, which is a very promising startup here in Europe, and we're doing mobile community identity. I hope this qualifies for the lessons learned.
Hello, I'm Gilles Deluge. I have 15 years experience on mobile and internet. I joined Patron, which is a Yellow Page group in France 2 years ago as head of strategy. And we acquired a very successful startup, Austrian one, 1 billion, a year ago, and I joined the company and moved to Vienna since the beginning of the year.
Hi, my name is Paul Joseph. I'm a VC based in Hamburg, Germany. We're a fund called Noel's Partners. I myself have been a VC for about 12 years. I'm originally from Slovakia, so very close to here, but investing throughout Europe, out of Germany.
So I'm going to go around a little bit and start asking questions. I want to start with Christian. We were talking about this a little bit earlier, and so you woke up one day and said, I'm going to start an airline. So how did that happen? Why did you do this? And I know that some people might know the story of Sky Europe. It's pretty dramatic. So maybe you want to walk us through it.
The first positive thing is that I started to write the business plan with 25. So at that age you have nothing to lose. You normally don't yet have a mortgage on your house or kids' responsibilities, so you can really take risks and start a crazy project. I think it would actually be more difficult today. So the lessons learned is that maybe there are 3 lessons that I would like to share with you. The first lesson is that we did an IPO in 2005, and while it's a great experience to do an IPO and to do a roadshow and to meet institutional investors, I think, to be honest, that it was too early for our company. And if I could give one advice, it's don't rush to go public. If you have a chance to remain a private company and to really focus on your business and grow the company to a stage where it has already reached a critical size. Being a public company is very sexy, but it puts a lot of obligations. First, in terms of transparency, a lot of reporting to do on a quarterly basis. Takes a lot of management attention away, and on top of that, if you are the only one in your sector to be transparent about your results and your competitors are not, it puts you in a difficult position. So that's the first thing. IPO is good, it's good for the investors, but it's not always good to do it too quickly. Second lesson maybe is in the airline business it's an equation between growth and profitability. So you have to find the right balance between growth and profitability. Obviously, it's a business where the economies of scale play an important role. So you need to grow very quickly at the beginning to reach a critical size. It's comparable to some internet businesses where you also need to achieve a certain market share, but in the airline business it's not just the revenue side which is important, it's the cost side. And the economies of scale on the cost sides are absolutely tremendous once you reach a certain size. So you need to have investors that are ready to fund this startup phase and this growth period. But then at a certain stage, and it's important to remember this when you are an entrepreneur, a founder, because founders are always targeting growth, but I think at a certain stage you need to slow down. Once you have reached this critical size, it's very important to actually show the world, show your stakeholders or investors that your company can actually be profitable. And so it's good to alternate a phase of growth with a kind of pause where you actually consolidate things and where you actually start to show some decent margins. So I think our mistakes is that we were kind of exclusively focused on growth, and we maybe forgot to make this little pause and to show profitability. We actually achieved profitability in 2007 on our operational basis, just when I left. Then there was a new investor who came in, a US hedge fund, and they changed management and they changed the strategy. And I think that was maybe the third mistake. I mean, for me it was good because I sold in 2007 just before the crisis, not in 2009 when the airline went bankrupt. But what I learned from that is that it's not good to impose too radical changes of strategy because it actually takes a lot of time to fine-tune the business model, and every time a new shareholder takes control and wants to change things radically, they build something new, but they also destroy the existing part. And I think it's like in politics, when a new government comes to power, they always pretend that everything that was done before was bad, but in fact, continuity is actually what protects the value. And what basically was not wrong at that time is that they decided to downsize. And when you have a business that just reached critical size, the worst thing you can do is actually downsize it, because then you again get into the problems of higher cost and so on. So that's maybe one of the lessons that is important. Downsizing a business that just reached critical size is not the obvious thing to do. Maybe the last thing, Sky Europe entered the Viennese market. And it was very bold move to actually attack Austrian Airlines and Flynicki. And it was quite an interesting story because at a certain stage then Flynicki and Air Berlin made an offer to the shareholders of Sky Europe to buy Sky Europe, and the investors would have done about 3 times their investment, which was not bad return on investment. And they decided that it was not yet the right time to sell, and they were basically too greedy. They wanted to sell at an even higher price, and basically they lost then everything. So the lessons learned here is that when you attack a competitor and you provocate him, and he actually offers to buy your company, the logical thing to do is actually to sell it, because it doesn't make sense to attack in the first stage and not to sell afterwards. So there. I would say the lesson learned is don't be too greedy. When you have the opportunity, take the money and run, because simply the environment can change dramatically, and a company that was worth 120 million euros on the Vienna Stock Exchange a few years later was worth nothing. So that's basically the story. Again, it sounds maybe as a sad end, but it was a fantastic experience. We really learned a lot. Yesterday I was at a the party of ex-Sky Europe employees, and what really was great in this company is that we created a fantastic spirit, so even a few years later, the people are still remembering this, so this is really maybe also an important thing as an entrepreneur, is to create the right corporate culture, and when you have a corporate culture that survives a company even several years after it's dead, that's in a way a success. Thank you.
Yeah, thanks very much. And that's a really good point. I have friends who decided to go IPO too early. They spent some of the worst years of their lives working on SEC paperwork and things. I think that's really, that's validated by many people that have done that early. Pavel, I'm going to go to you next and ask you. So you've got a fund based in Berlin. You've got a pretty broad range and a lot of portfolio companies. And if you've got a particular perspective of patterns that you see, things that they do well, advice to startups, maybe you want to share a little bit about going on from a particular perspective.
Sure. Yeah, so I think every investor is kind of thinks that part of his job description is pattern recognition, and that's what we do as well. We kind of try to see across a portfolio what works well, what doesn't, what things are indication for future success, what things are early warnings for failure. And I think there are two things I would like to mention right now. So the first thing is focus, and it applies on many levels. So by focus I mean that as Morten said before, building a company is a full-time job. It's 365 days a year, 24 hours a day. But still, and especially in Europe, it happens so often that people do many things at the same time, many companies. So they come to you, they show you their business plan, you say you don't like it, so they pull out another of the pocket. And that's strange, that cannot work. And we believe that focusing on one thing is the right thing to do in the beginning, but also later, when the company, when there's a team that's focused on the company, and the company starts working, and it becomes an organization. Very frequently, the CEOs they kind of feel the need to start something new on the side, but the first company is not sorted out yet. But they start doing it, they lose the focus, and the company always suffers. Even though if you start doing a new thing, the first company doesn't collapse immediately, but it loses day by day. And we've seen cases where the CEO of the company, they kind of noticed that, and they kind of killed the other project and focused on the proper one. But also there were cases where the companies really suffered badly, and the corporate culture falls apart because the employees know the CEO is his side affair, and so is it really the key company for him you're working in, or is it something just So I believe like focusing on just one project is key, or maybe like not focusing on it is a very likely way to fail. And I mean there are also successful examples to the contrary, but I think only very experienced and accomplished entrepreneurs can afford themselves the luxury of doing a few projects at a time, because they have the resources, they have the credibility, they have the leverage to pull off a number of things at the same time. So focus, I believe, is one thing, or at least not focus. No focus is an indication of trouble down the road. And another thing is focusing on metrics. I think we cannot stress it enough, but if the management teams, if a team doesn't think about the business, or is not able to think about the business in terms of numbers, that's a sign that something can go wrong in the future. And I don't mean by this, PhD style, 10,000 kind of sheets in a spreadsheet. I just mean kind of understanding the key drivers of a business in terms of numbers, because business is about numbers in the end, and understanding it on many levels is critical. But at the same time, don't overdo it, because as we frequently say, kind of business planning in Excel is the most sophisticated form of science fiction. So I think the key is to find the right balance.
Thanks very much. That's interesting too. So I've seen a lot of pitches, and that point where if you get somebody who pivots too quickly, or you get the impression they're showing you what you want to hear, they have a plan B, like out of the back pocket. It's almost like somebody who's like has an array of like fake Rolex watches or something. The conversation just stops right there. So at least like if you're pitching, and you get the impression that the VC is like asking more questions, they don't like the business plan, at least pretend like you're listening and then go away and think about it and come back again. And if the team's good, and if the technology's good, you're probably going to get a second chance. But I'm going to move on Mark Petty now and ask you a little bit. You're now the CEO of Wikitude, which is doing a really great job. And but if you want to talk a little bit, you had another successful exit while going so fast through the Digital River. And if you want to talk a little bit about that, sort of find an exit in the US, and learn interesting stories, dirty gossip, whatever you want to talk about that.
Yeah, sure. So basically, one key thing for us there was basically going international. Because when the company was founded back in 2004, the startup team in Vienna and Austria was kind of desperate. So we had a really significant disadvantage of being in Vienna. So when we had our monthly startup get together, we have been 4 CEOs meeting every other week and really having a good beer together. But then it basically was hard to basically exchange expertise, exchange networks, exchange content. So that's why I'm really excited about this whole spirit here, really how dramatically the situation has changed here. From a 4 people together in 2004, now we have like 1,300 participants at this startup week. And so I'm really glad to be part of that. Basically moving back in days, so when I said going international, so from my perspective, Vienna was lacking entrepreneurial spirit, Vienna was lacking capital, Austria was lacking network, Austria was lacking exit channels. So for us, the secret of success was definitely to go outside of Austria, to basically spend so much time on planes as possible. I think I could renew my gold card at Lufthansa already like in April each year because I like just the flying economy. And that's at the end of the day, this was then the secret of success. Still, as I mentioned, times have changed quite a bit. Well, exactly, right? That you didn't fly to the United States, right? Did it? Yeah, so this was the first big lesson. So the second big lesson was keep your options open as long as possible. So one of the big mistakes we made on the Fit side, despite the good exit, but still we took investment from a strategic investor while we were still in the growth phase, while we were still in the pre-revenue or pre-break-even phase, and still would have needed external capital, would have needed external network. Basically, these doors were closed simply by having a strategic investor on board. At the end of the day, this investor then bought the company, which was good, but still also from an exit procedure, it was impossible to offer the company to other potential investors, to other potential acquirers, simply because this investor was already in there, had the option basically could buy the company for a pre-agreed price. So I would never do that again. From a positive perspective, something that was really important for us, or to call it stamina, and I think this was really important for us as well. So I had really heard of a startup where the initial idea, the initial concept, the initial business plan actually then brought the company to break even and into a successful exit. So on the Fit side, I think we have changed business models 3 times, we have changed positioning 3 times, until we have found the right go-to-market approach and the right model how to succeed, and at the end how to create an asset that was worth being acquired by a Nasdaq-listed company. And I think these were my 3 main points when looking back at the Fit days.
Okay, thank you very much. Actually, this makes a good transition. I want to ask Paul a little bit, just sorry to skip, about some of the hazards. You worked with SAP Ventures, and now you're in White House, so also raised a private fund. And so, what are some lessons you learned, and some things startup should understand about working with a corporate fund like SAP or Nokia versus going with a private VC?
Well, so I spent about 6 years, I'll refer to it as the corporate VC game. It's constantly trying to convince the entrepreneurs who you invest in that you're going to add some real strategic value, and that's why they should take your money. It's not just dumb money. There are corporate VCs who do tend to help you out, but don't ever expect them to do a lot of heavy lifting for you. Corporate VC arms, I'm probably going to get in trouble for this, but corporate VC arms tend to be kind of where people are put out in the pasture in a lot of companies. Certain groups, like Google Ventures, for example, set up a separate vehicle, and they're professional investors. A lot of other corporates tended to in the past have corporate venture arms that were more a hobby than anything else. And to be honest, they hardly ever really hit the bottom line of the large business that they were a part of. And if you're not a business unit within a large corporate as a VC, you're kind of irrelevant. So to turn that on its head, if you're going to work with a corporate VC, I would highly recommend having very clear definitions of what you expect, and do this before they invest in your company and before you take their money. And then also make sure that you talk through their current portfolio and find out how much of the strategic value that they promise they actually end up delivering. I personally now, having gone to the other side of being a private VC and then going out and actually raising the money that we're investing, tend to actually sway away from having a corporate VC involved, because there's a general fear in markets about what corporate VCs mean for you. So on the positive side, they can be of value, but there's a couple of hurdles that they can put in your way. One of the major ones is when you're trying to sell the company and you're exiting. So, for example, if you think the airlines, if Lufthansa was a shareholder in your company, it would have been very difficult to sell to one of the other larger players in the market. Same thing for a lot of the startups. If you have, I don't know why I can use as an example, but if you have some corporate VC in your arm, it means that one of their competitors might not buy you. I know that at SAP, it was always, would Oracle buy us if SAP is invested? It actually did happen in a couple of cases, but it was few and far between. So I would actually recommend, to your question, that working with corporate VCs is always a double-edged sword, and you really need to do your homework before you take the money, and fallback options. So if, let's say down the road, 2-3 years from now, you see the opportunity of having a corporate VC involved, start that relationship now, make sure you have the stamina and everything to build a great business, and go get them on board when you're in a position of strength. Don't ever go to the investors when you're in a position where your back is up to the wall, because you're just not going to have any leverage. You're not going to really be able to push them on the hard questions of what are you willing to deliver. You might not even have the balls to go and say, look, put this on paper, put this in the contract, that you're going to give me something in addition to the money that you're investing.
Okay, thank you very much. Sheila, I'm going to move on to you a little bit. So I know you've got a background in telecoms, and you've been with Surpage, the Yellow Pages, and the acquisition of the people we went through. We're going to take it in 2 parts, talk a little bit about telecoms. That industry, startups are trying to break into that industry, with particular advice, particular traps that they might face.
The telco industry is really different. I started in this industry in 1994, so quite a long time ago, just when it started. I joined the company, there were 100 persons, there was no revenue. We launched everything just a year after, just time to build the brand, time to build the network. When I left it was doing 3 billion revenue, and there was 7,000 people. So let's say it's a huge startup, of course. So how can you characterize operators? First, the way I see it, each country you have 2, 3, 4, 5 operators. So the competition is not so hard, because they won't die, that's for sure. So at least it's okay. It's not too competitive market. That's the first one. The second one is all the innovation they've done until now was really technical driven. And it was less user-driven. We can see it. I was, in year 2000, I had a strategy for the company, thinking about UMTS, third generation. We had to invent the future. that was interesting. IMA did it very well in Japan, but still they couldn't export it. So always technically driven, not easy to use, only for geeks or a small part of the population who could use the service. Except one, always very successful, of course, the SMS service. Third learning is that operators are very local, even if Vodafone, Orange, or companies which are European-wide or worldwide, still the offer they're doing, what they're proposing, which are data offers or voice offers, also very, very local. Services they provide are local. So at the end, when you hear this, you think, okay, there are good networks, but what about services? So then it gave a huge opportunity to US companies like Apple, like Google, to have user-friendly services, worldwide services, global services, and to spread it all over the world, as you can see. And so they found their positioning compared to the telcos. So the learnings at the end are, if you're in the two secret markets, be careful, that's the point, of course. Don't think about technology, but think about the user, that's very important, and at least it's better to think global than local. Talking about Belgium, I was also head of strategy when I joined the company. We had a big issue. You know, all of you knows about the phone book, okay? It's for a phone number, phone address. Okay, what's the future of the phone books? Difficult, huh? So on the business side it was okay, but on the, what we call the white pages side, very difficult. So we scanned a lot of companies, and one startup knocked on the door and said, okay, we'd like to meet you. It was a really small startup. And they told, okay, we'll call 1 to 3 people, and we'd like to do a partnership with you. And it was really a company, they knew about it, but they were doing already a huge traffic in the country. So, okay, we're impressed. So the reaction was, okay, we don't want to partner, but we want to get some shares in the company, because we saw that maybe this was something to do. So they went back, they tried to make a partnership, and then a year after, we met again and said, okay, we're ready to sell. And then we started what we call a buying process. Very interesting, knowing that we saw that there's a huge asset, very interesting brand, international, a great team, so it was doing very, very well. And so it was really 3 months, like a sprint. So what you have to keep in mind is that nothing is done until you sign, that's for sure. You don't know what happened in the head of the person who is in front of you. On my side, as an example, I had to convince the group that investing in the white pages business, as I explained, was interesting. And the way to do it is to create a vision. So the vision was, okay, this is a huge asset, and we can use it on the business side, which is really the asset of the Yellow Pages companies. And I had to convince to get the signature, of course. So that is very, very important. Please, each time you do it, never forget that you need to sign. I have another example, because I used to acquire quite a lot of companies. We signed once, there was another one, it was about 11 o'clock. He signed. The entrepreneur signed quite quickly, but then just after signing, he said, you know, when I woke up this morning, I didn't know if I would sign or not. It was 50-50. So, and the only reason why he signed, it was a human factor. Okay, he signed for the person who was in front of him, of course. Now he's very happy.
Thanks very much. So I'm going to go back a bit as you talked, Christian, about Europe, and you recently bought Panorama, which is an interesting company. And I'm wondering, because previously it wasn't profitable, you were saying backstage earlier, now it is. Is there anything that you can talk about, things that were important in sort of getting profitability, getting a bit of momentum behind Panorama, also give you a chance to plug in your start?
So, Panorama is a French company that exists for about 11 years now. To summarize it, it was Google Maps 5 years before Google Maps, because it launched its technology in the year 2000 and Google Maps launched in 2005. Obviously, when Google Maps came on the market with mostly free services, the company had to reinvent its business model because it was basically focusing on technology at the beginning with heavy VC investments, and didn't focus that much on revenues. And when the internet bubble was over and funding was not available anymore, it had to face some treasury issues. So I had the opportunity to actually buy the company in distress. I bought the assets, not the liabilities. So I had basically a brand new company buying all the technology, the team, and the customer portfolio, and starting from from scratch, so it was a great opportunity. On the other side, it was a very different experience from the pure startup experience. Because in startup experience, you start with a white sheet of paper, you have a lot of motivation from your people because you are building a new brand. And when you restructure an existing company, you also buy the past, and it's not so easy to put people back to work. But we achieved this, and I bought the company in 2009, and now 2 years later, and we're basically profitable because we completely refocused on the B2B market. So it was basically a B2C brand that has now been refocused on B2B. We became a partner of Google, so we're actually reselling their products. But on top of that, Google Maps is actually more a consumer product, and we are using our technology to actually adapt this solution for the enterprise market. So we have large customers who have to visualize huge volumes of data from their business intelligence systems, or their CRM, or their ERP systems, and we use Google Maps as a layer, as a map layer. But what is important is actually what you put on the map. So if you would compare this to a weather map, what actually matters is the meteorological information, but you need the map to visualize this meteorological information. So our business today is not anymore the producing maps, but visualizing information on the map. So it's in the field of data visualization, and there are actually a lot of things going on there, because people spend a lot of money buying their BI software or their CRM software, but they actually don't always know how to exploit and analyze the data. And the map actually allows you to visualize this data in a very intuitive manner. So that's the story of Aquama, and it's actually interesting to move from an entrepreneur founder position to an investor position. And obviously, when you play with your own money, it's also a different game. But I've learned a lot from that, and I think that actually it's good that entrepreneurs put their own money on the table. It makes a significant difference when you have your own money at stake, because I think there are two motivations. Sometimes you have the motivation to win, and sometimes you have the motivation not to lose. And actually the two motivations can be as important. So and when you have your own money at stake, the motivation not to lose it is quite a key driver to it.
All right, thanks very much. Mark, I want to just jump back to you really quickly. I know with Wikishoot, so has grown really dramatically over the last year, and you guys have done really well. I've worked on the Wikishoot team for a while, and just coming out of a little tiny place like Salzburg, kind of unknown, and going up against Dutch company, who has way more funding than you guys. You guys have done really well. Is there anything, why? Question, what's been the key to that?
So basically doing really well is a relative statement. So it's basically Chris mentioned that they are profitable. We're not profitable yet, but actually pretty far away from being profitable. And so this is still a big check mark that has not been checked yet. But apart from that, I think we really did well. So just starting off looking around the funding in October last year, which was, as you mentioned, like a small fraction of what the competition has got, but within the last year, we've really outperformed the whole market. So by the end of the year, we'll have like 10, 12 million installed clients out there. We'll be pre-installed in BlackBerry, and despite BlackBerry isn't the rising star of the smartphone market, they're still selling 52 million units per year, and Wikishoot will be on it, so that's significant for us. I think we've done really well on the operational side as well as on the business development side. One big thing for us was, of course, again, going international. Our media relationships are based in North America. Of course, we have a tremendous media support over there, but apart from that, I think so the last year was successful. And the big exercise for 2011 will be to implement the right business models. Now having reached this great user base, to really start monetizing them and achieve a break-even state by the end of next year.
Okay, thanks very much. I don't know if we have maybe a few minutes for Q&A. If you want to ask any questions to the panel, I'm going to go around the audience.
So hi, my name is Łukasz and I want to ask you, Christian, I thought you touched on an interesting point on taking the money and running. How do you, of course in that case there would never probably be a Facebook or Twitter or anything. How do you decide when are you going to the top on by yourself? And when do you take your money and run?
Oh, it's a difficult question, but I would say if I would have been the founder of Groupon, I think I would have sold. Because you never know if at the end every hill has a downhill slide too, so you actually never know. But the fact is simply that I think the message was just don't be too greedy financially. It's a different thing if you still believe that you have things to achieve in the company, that your vision is not yet accomplished, and you got your business, it's your baby, and you want to raise it to maturity. Then of course you should stay in the business. My message was just purely from a financial point of view. If you have an opportunity and you're happy with the terms and you have a good return for your investors, for yourself, well, you never know if you will get another offer like this tomorrow. So I would really distinguish between the operational motivation to grow your business and the financial motivations.
Again, and also a vision from the other side. When I acquire a company, okay, what are the key success factors for me and what I've seen until now? We are like a media company. In 2004, they were doing 4 million revenue. Now they're doing 30 million. For home improvement, it's a lead company. 2 years ago, they were doing 2 million revenue. Now they're doing 10 million. Okay, and of course, founders, co-founders are still in the company. And same for 1, 2 people. Today, we're trying to leverage them in the business, okay, environment. We want to in the people environment. So for me, there are 3 success factors. The first one is the vision. So the company who buys you has to have a vision. And a stable vision. That means that the person who buys you is to be sure that the vision he has is locked in the company for at least the 2-3 coming years. Otherwise, if they change the idea 6 months after or a year after, it's very, very difficult to maintain the business. So that's the first one. The second one is just a human factor. I think it's maybe 90% of what happens. If you want people to stay in the company or you to stay within the company, you have to feel the relationship between the person. So that's really, really, really important. And the third one is about synergy and autonomy. The risk, of course, is when you bought by a company is to merge. When you merge, and it's very difficult then to create value. So autonomy, that's what we used to give to companies, but at least you have to define with the buyer what kind of synergies you have. Usually what we do, we say that there's no synergy. We don't bet on synergy because we know it's super difficult, but at least after we leverage it. So my recommendation is not to put a price on the acquisition. Okay? If you say, okay, I will get more if I can deliver the synergies in the future with the group, that's, I think, very dangerous. If you want really to sell it, and if you have an earn-out, the idea is just to deliver your business as you know how to do it in the 2-3 coming years, but not to depend on the group. Of course, you will have more in the group of being your value, but this is a bonus. You have to consider it a bonus.
I would also add one point to this, the VC side of the equation. You can listen to panels, you can read whatever you want, everything. It's like basically, what are you going to do if someone, tonight puts a gun to your head? You think you know how you're going to react, but when the gun is at your head, you're probably going to react differently. It's also very different when you're sitting there and someone's about to write a check where your net worth is about to jump by 10 or 20 or 30 million. I've been in a couple of these situations where we had an acquirer willing to buy, or vice versa, we had a founder looking to sell. And it's funny, people always think they know how they're going to react, but the effect of 10 or 20 million in your bank account is such a life-changing effect that you have to wait and see until you're in that situation. And one of the things that people always forget, and you mentioned Groupon, is that you're not always in a position as the founder to determine whether you want to sell or not. There happen to be VCs who gave you your money to grow the business, and I don't want to say it's good or bad. It's the point I'm saying the reality is far beyond what you often see. I've had so many of these conversations, but to the outside world, it looks like entrepreneurs said, no, I don't want to sell, I want to make this really big. It wasn't really the founder, it was the VCs who basically wanted to keep them in the business. So you have to always kind of make sure you're in position. I think, who is that? I don't know. So yeah, it's always each person, so don't take what you see in the market as how you should react.
Okay, thank you very much, Paul. Thanks a lot to all you guys, our panelists, and thank you.